All right, let's jump right into this explainer on a real game changer, the crucial Chapter 8-C deductions under the new Income Tax Act 2025. Whether you're a chartered accountant, a tax professional, a student, or a business owner, getting a grip on these new provisions is absolutely essential as we finally transition away from the 1961 Act. Today, we're focusing specifically on deductions in respect of certain incomes, covering Section 138 all the way through to Section 152.
So here's our game plan for today. We're going to cover the hook and introduction, the core legal provisions, a detailed provision breakdown, a practical taxation example, compliance and common issues, and wrap it all up with a summary of key takeaways. Let's get to it.
Section 1. Hook and Introduction. Let's start with a scenario you're probably seeing a lot lately. Imagine this. A client sits across from you in your office. They've got an eligible startup or maybe an undertaking in a special economic zone, and they ask, hey, how do we claim our profit deductions now that the old tax law is out? If you're advising them post-transition, you've got to know exactly how the old rules map over to the 2025 Act. You just can't rattle off the old sections anymore.
Moving into Section 2, Core Legal Provisions. Let's look at exactly how this new framework is built.
This is pretty cool because the transition is actually super straightforward. We all know the classic sections from the 1961 Act, right? ADIA for infrastructure, ADIAC for startups, and 10AA for SEZs. Well, under the Income Tax Act 2025, they've taken these, consolidated them, and streamlined the whole lot into Chapter 8-C. Specifically, we're looking at Sections 138 through 144. The goal remains exactly the same, incentivizing specific economic activities, but the statutory language? It's so much more logical and reader-friendly now.
Now here's a massive shift you absolutely need to understand. We are moving from the old assessment year to the new tax year concept. And the best part? No missing years during the switch. According to Section 536.3 and the official FAQs, income earned in financial year 2025-26 is assessed in assessment year 2026-27 under the old Act. But starting April 1, 2026, income earned in that year is assessed in that exact same tax year 2026-27 under the new Act. The terminology lines up perfectly. Zero overlap, zero gaps.
So what's the golden rule here? Well, it's a hard boundary you've got to remember. Just like the old Section 80AA, your absolute total deductions under Chapter 8-C cannot, under any circumstances, exceed the assessee's gross total income, or GTI. This ceiling is hard-coded into Section 122 of the new Act. Long story short, you cannot artificially create a loss just by claiming these profit-linked deductions.
All right, Section 3, Detailed Provision Breakdown. Let's get into the nitty-gritty of who actually qualifies. Looking at the official guidance for the new Form 32, we have a clear list of the specific undertakings eligible for these Chapter 8-IC profit deductions. Section 139, that's your SEZ developers. Section 140 is for eligible startups pulling in profits from their eligible business. 141 covers commercial gas production and oil refining. 142 tackles housing projects, and Section 143 is carved out specifically for undertakings in northeastern states.
But wait, it's not just infrastructure and startups. Chapter 8-C also brings in certain foreign incomes. For Sections 151 and 152, which deal with foreign inward remittances and royalty income, there is a strict, absolute maximum statutory deduction of 3 lakh rupees. That's a hard cap, folks. Definitely something you need to flag when advising individual professionals or authors who are raking in foreign royalties.
And as you'd probably expect, the 2025 Act isn't letting anyone game the system. It strictly retains the old anti-abuse safeguards, meaning you cannot artificially inflate your profits by shuffling goods, services, or funds between eligible tax holiday units and non-eligible ones at made-up rates. Everything has to be strictly at arm's length. If the assessing officer even suspects you're shifting profits into the deduction-claiming unit, they have the full power to step in and recompute those profits.
Moving on to Section 4, Practical Taxation Example. Let's see how this actually plays out in the real world.
Say you're advising an eligible startup under Section 140. You're going to follow 4 exact steps. Step 1. Make absolutely sure the startup is earning profits specifically derived from the eligible business. Step 2. Run an internal audit. You've got to verify there's no artificial inter-unit profit inflation happening. Step 3, and do not miss this. A chartered accountant must verify and file Form 32, exactly as laid out in the new Income Tax Rule 66. And finally, Step 4. Claim that deduction in the return of income, just making sure it stays under that gross total income ceiling we talked about.
Next up, Section 5, Compliance and Common Issues. Because honestly, knowing the law is only half the battle.
The compliance paths here under the Income Tax Rules 2026 are literally night and day depending on what you're claiming. For businesses, infrastructure, and startups under Sections 138 to 144, you're looking at Form 32. This falls under Rule 66 and requires verification by a CA. On the flip side, if an individual wants that 3 lakh rupee deduction for foreign inward remittances or royalties under Sections 51 and 52, they need Form 38, governed by Rule 72. And here's the kicker. That one specifically requires certification by the bank manager of the receiving bank. If you mix these forms up, you're looking at instant processing failures.
So let's talk about the traps you absolutely need to avoid. Using those obsolete 1961 Act forms after April 2026, that's an instant rejection. Confusing tax year with assessment year, that's going to have you claiming credits in totally the wrong period. But the absolute biggest, most dangerous mistake? Missing the timely return filing prerequisite. Under Section 122(5) of the 2025 Act, if you fail to file your return of income on or before the due date, it completely invalidates your Chapter 8-C deduction claim. Bam! Deduction denied. Just like that.
Which brings us to Section 6, Summary and Key Takeaways. Let's pull all this together.
All right, lock these 5 points into your memory. 1. The transition brings familiar concepts into new buckets. Sections 138 to 144 are your new go-to for business deductions. 2. Tax year replaces assessment year without skipping a beat. 3. Your deductions can never, ever exceed gross total income. 4. Compliance is the name of the game. Form 32 needs a CA and Form 38 needs a bank manager. And 5. Remember that 3 lakh rupees ceiling for Section 151 and 152 remittances. Master these, and you'll navigate the 2025 Act transition like an absolute pro. So let me leave you with this. Are your clients' compliance systems actually ready for this April 2026 switch, or are outdated habits about to cost them their deductions?
Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.